if any decision is made to open up concept tests again, students, so two students learn. So Mr. Dioda is basically we're going to continue that, and hopefully Mr. Dioda is going to so chapter in the to know your notes, and these notes are what we're going to be working through. It's called your theory, and obviously your theory is not, you've got to be able to apply it, so you're going to be doing tutorial questions and other questions. So you need to make sure you master this document, and there's also some slides that you can master, right? And also your tutorial questions. So don't look in the textbook for this chapter; it's not there. The notes are provided separately. All right, let's go into, and this week is going to be your. It was also announced this week is going to be tutorial 4, property, plant, and equipment. Right. So let's start with our intangible assets. Previous week we did a topic called property, plant, and equipment. We said that the definition of property, plant, and equipment is that it included a phrase that meant that it had to be physical. You had to have been able to touch it. It had to be completely apparent. It had to be a physical substance, like machinery, land and buildings, ships, motor vehicles, office equipment, that kind of thing. What if you go to Coca-Cola Limited, right, based in, let's see, where's Coca-Cola? Okay, the United States, Atlanta, Georgia. So let's say you contact them and you say, hey, I want the right, and obviously you're going to have to pay for that. I want the right to be the only person in South Africa to be allowed to sell Coca-Cola, Fanta, and Sparletta, and all whatever brand Coca-Cola has. I want to be. Obviously, you'll have to pay billions of US dollars, and they're not going to give you anything except a piece of paper, all right, saying that you can produce Coca-Cola. Right. Why would a person pay billions of dollars for just a piece of paper? Because that piece of paper has value. You're the only one that can sell Coca-Cola. You're the only one who can sell that brand. It's an intangible value, right? So it doesn't have a physical, it's not machinery, it's not, but it does have value. Right? So that's what we're kind of talking about when you're talking about intangible assets. Okay. So how do you get an intangible asset? Right? You can purchase it, like what we just talked about, you can purchase it. You can also exchange it for an asset. You could give someone a vehicle and they can give an intangible asset. Acquired as part of a business combination, that's when you merge with another business. Right? Or you're the parent company and you purchase a subsidiary. For example, you are Facebook, you purchase WhatsApp, or you purchase Instagram. Right? You know, the holding company is Facebook, the subsidiary is WhatsApp or Instagram. But it's not going to be examined in 1 or 2 yet. You're going to be able to have a look at that next year in accounts 2 in consolidations and business combinations. Another way that you won't be required to you're required to know right now is acquired by way of a government grant. Another one is internally generated. Right? So we're going to have a look at these later on. Okay. So remember, when you are studying any standard, we said that there's going to be 4 broad categories. The first one is initial recognition or initial theory. Let's just say theory. The first one is theory. What do we mean by theory is this transaction that occurred, does it fall into the standard? Right, so that's your theory. The second part is initial recognition. If it does fall into the standard, how much are you going to record it at? Subsequent measurement is your third part. And that tells you after years go by or time goes by, how do we continue to measure this asset or this item? And the fourth part will be how do we show it in the financial statements, presentation, and disclosure. So we're starting off obviously the first part, and that is theory, which is extremely important, right? You must master your theory and be able to apply it to given questions. Okay. So recognition, what does recognition mean? When are we going to be able to debit intangible asset cost, right, in our statement of, in our general journal? When are we going to be able to recognize an asset, debit an asset, and recognize it for the first time and send it, bring it into our financial records? That's what we're talking about recognition. When are we going to recognize it? So it's got to meet the definition of an intangible asset and the recognition criteria. Remember, just because something is defined as an asset, right, doesn't mean that we can recognize it. Right? It's got to meet both the definition, so it's got to be an intangible asset, and it's got to meet the recognition criteria that makes it an intangible asset to us that we can recognize. Okay, so let's go into the first part, and that is the definition of the intangible asset. So what's the definition of an intangible asset? It's an identifiable, non-monetary asset without physical substance. Okay, now this definition needs to be broken up. Each word here or each phrase needs to be broken down. The first one is identifiable. There's theory behind that. How are we going to prove that this intangible asset is identifiable? Number 2, it's got to be non-monetary. So we're going to look at how do we prove that it's non-monetary. Thirdly, it's got to be an asset. Remember, before when we were babies, or before when we were, we used to just throw the word asset around loosely. But now we know that asset is defined by the conceptual framework. So we have to prove that it is an asset as per the conceptual framework. We also have to do this for PPE. Right? So that is 1, 2. That's the third part of the definition. And the last part is without physical substance. So each word is actually a chapter of what we're going to be discussing. Okay, first part, identifiable. How do we know that this asset is identifiable? Can we basically what we want to do here is we want to make sure people don't just invent assets out of thin air. Right? It's got to be identified. We've got to be able to identify. We can't just have something in our head or something in the imagination that, hey, I'm starting off a company and I feel that my name Mohammed is very people really respect my name Mohammed because I'm a lecturer here at UKZN. So everybody is going to be able to is going to come to me and purchase, for example, if I'm selling drones. So I'm going to recognize my name Mohammed as 1 million rand in my statement of financial position as an asset, brand name Mohammed. So I can just invent millions of things, and I can just say that I have a billion rand worth of assets when really I got nothing. Right. So that's why we're going to look at this definition to make sure that this intangible asset is valid. So the first one is identifiable. When is the asset identifiable? It's got to meet either one of these criteria. Right. It's got to be that the asset is separable. Right. So I can take this asset and separate it and give it to another company, or sell it to another company, right. Right, or it must arise from contractual or other legal rights. So it doesn't have to be both. It's got to be or. Right. So let's look at the first one, separable. In order for something to be seen as separable, it's got to be capable of being separated or divided from actually it should say equity, or you can say entity, from the entity. It's got to be able to be separated from the entity. So if I've got a brand name, let's say I've got the only right or to make or to sell Nike branded shoes, right? And I can take that right and sell it to someone else, and my company can still exist. Right? So that can be separated. Another one, sold, transferred, and remember this word is and, so it's got to be both. Sold, transferred, licensed, rented, or exchanged either individually or together with a related contract. So basically sold. Can I take this and give it to another company or sell it or license it to another company? If you can, then it's identified, then it's separable. And if it's separable, then it's identifiable. And regardless of whether the entity intends to do so or not. Why is this important? Because if you have, for example, a brand name, but you want to keep it, that means that you're not going to sell it, but it doesn't mean that it's not separable. This is just like a clause, like a proviso to make sure that we don't exclude an intangible asset just based on the intention of the entity. Right? So basically, can we transfer this intangible asset or this item from one entity to another? Okay, so that's separable. If it's separable, it's identifiable, and you've met this criteria. The first criteria of, now remember, it doesn't have to, if it's not separable, meaning it's not capable, it doesn't meet all of these criteria, these three criteria. Right? Basically, it doesn't mean that it's not identifiable, because there can be another way that it becomes identifiable, and that is that it arises from contractual or other legal rights. So if an item is not separable, identifiability can still be proved where contractual or other legal rights exist. These rights must be considered even if they are not transferable or separable from the entity or from other rights and obligations. So let's do contractual and other legal rights. Contractual rights are rights that an entity acquires as a result of entering into a contract. Other legal rights can arise by acquiring an item that gives entity certain rights. Right. So let's look at examples of this. So for example, let's say we go to the government and we apply to them that we want to be able to mine 10,000 hectares in Ladysmith. We think there's diamond there, so we want the right to bring massive machinery and development and all kinds of equipment, and we want the right to mine them. We explain to them that we're going to do this. We're going to worry about the environment in this way, and we're not going to damage it. And we're considering water. So we go through a whole process to apply, and they give us that legal right for 3 years. They say, okay, look, you obviously are a responsible company, and you've met all the criteria. So your company, let's give ourselves a name. We are UKZN Miners. We are going to go and mine Ladysmith, and we have the government. They're giving us a 3-year license to go and mine in Ladysmith and find diamonds. Now they've given that to us. We can't take this and sell it to someone else. They have so can you see the difference? Right. So although it's not separable, it still arises from legal rights. So that would be identifiable. So that's what they're talking about, contraction and legal rights. Okay, you may not be able to transfer it to someone else, but it still arose from a legal right. Okay, let's look at some examples of some intangible assets. For example, what is a patent? It gives the holder an exclusive right to a process, design, a new invention for a certain amount of time. For example, a new drug is developed by Aspen. They register a 5-year patent, and no one but Aspen can reproduce that item or create a generic for 5 years. So let's say Aspen goes and invents a pill, and this pill, you take it and you cure the next day from coronavirus. They go and register this thing, and they say that, and they get told that you guys, because you came up with this design, you're patenting the process to make this pill, and nobody but you can produce it for 5 years. After the patent has lapsed, then another pharmaceutical company can produce the same drug and market it. So this is known as a patent. Okay. Another example, a copyright. So these are all things that arise from the contracts. Copyright gives creators of original ideas, art, etc. Also, it could be if you create some sort of media, right, the exclusive right to print, publish, perform, film, record, etc. for a given amount of time, and thereafter it becomes public domain. For example, Taylor Swift records a song and copyrights it. No other artist can use the same song words to another tune or the chords for a number of years. Okay, so that's known as a copyright. Right. And the last example we're going to look at is a trademark. Recognize, I think most of us will be aware of these, a recognizable emblem, phrase, or other symbol that is unique, that uniquely identifies a specific product, service, or entity. Right. We don't have to write your McDonald's that you know it's McDonald's. Right. So that's a trademark. I can't just go and open up a McDonald's and say I'm selling McDonald's burgers. I need to pay the holder of the trademark to allow me to go and do this. Right. So I think these are self-explanatory. The same with Nike. I can't just go and make T-shirts and put the Nike emblem on it. I've got to have the trademark. If I have the trademark, it's an intangible asset. So it's definitely identifiable. Okay, what about money spent on an advertising or marketing campaign? So I've got a brand. My brand is Muchinho's Chicken. Right? So I have started a new brand. It's called Muchinho's Chicken, and I want to advertise Muchinho's that we are the healthiest flame grilled chicken in South Africa. And I spent 500,000 rand marketing my brand. Right? That marketing campaign cannot be recognized. Oh, because it's not identifiable. How do I know it's not identifiable? I can't separate that advertising cost and sell that advertising cost to another company. And that advertising cost, it didn't arise from contractual or legal rights. So one is the brand and one is advertising of the brand. So the advertising of it can't be recognized. So every time they ask you, is this thing an intangible asset, you have to look at the definition. And when it gets kicked out from any one of these four items, then it's not an intangible asset. Okay. So we have discussed the first part of the definition, which is identifiable. It's got to be one of these two, separable or arises from contractual or legal rights. And then the separable has a separate breakdown. Right? Next part, non-monetary. It has to be non-monetary. Right? So to understand what is non-monetary, you've got to know what is monetary. Right? Monetary is cash. That's the key word here, it's cash. Now, so if you've got cash in your bank, right, bank account, let's say for example, you've got a net bank current account, R1,000,000. That's not an intangible asset because that is monetary. On your statement of financial position, let's actually open that up. Right? You can get a bit more context. Okay, so under my statement of financial position, I'm not going to write your intangible assets and write my bank account. That will just go under cash and cash equivalents. Okay, so it's not just your bank account, there's cash equivalent, meaning there are other things that are equivalent to cash. Other things that can be equivalent to cash, your current bank accounts, investment accounts like fixed deposits, money markets, and notice accounts. So notice account, you get like a 32-day notice account where you have to tell the bank, or a 30-day notice account, you tell the bank, I'm intending to withdraw R1,000,000 from this account. You have to give them 30 days before they put that into your account. So basically talking about bank accounts. So all of that is monetary, and that won't fall under intangible assets. It has to be non-monetary. Okay, got a question here, flexi account? Yeah, any accounts, bank accounts are monetary, so those won't be intangible assets. You'll just put them under cash and cash equivalents, not intangible assets. Okay, so we've gone through identifiable, non-monetary. The third one is got to be an asset. Right? I don't actually need to go through this. Right? We've gone through too many things, too many times. Asset, it's a present economic resource controlled by the entity as a result of past events. So you've got to prove this, that it's a present economic resource, and always the main thing is your control. Right? How do you prove control? You've got to be able to restrict access to other people using this asset or getting the benefits from it, and you've got to be able to get the benefits from it. Right? Risk and rewards, that's another keyword. Right? So when you're trying to prove control, these are the criteria that you use. Okay. So also, it doesn't have to be future economic benefits don't have to always be only inflows. It can also be cost savings experienced by the entity as a result of the resource. For example, let's say you pay for an expense for next year, you pay for it this year. For example, you prepay your lights, water, electricity. Prepaid expense. What's a prepaid expense? It's an asset because next year when you actually have that expense, you won't have to pay. So it's a cost saving. Let's have a look at this example. A company gives training to permanent employees that is specific to the company and will help these employees to perform more efficiently and effectively. Can this be recognized as an intangible asset? The answer is no. Although the training is identifiable and non-monetary and does not have a physical substance, the asset definition is not met due to the inability to prove control. Can you control people? They can just resign and they can go and use the skills for your competitor. So because you can't, that's also a reason why you can't capitalize your stuff. You can't just say, yes, Mr. Becky, Mr. Becky Dlamini is an excellent staff member. He is highly qualified and he has very good skills, and we want to recognize him. He's worth 10 million. You can't control him. So that's not an asset. So asset definition, we're not going to go too deep into it. We've already gone to it. You've got to prove the asset definition, which is the third part of your intangible asset definition. And the last part is without physical substance. An intangible asset has no physical form, unlike property, plant, and equipment, which has a physical form. So physical form, your machinery, you can touch it, you can operate it, vehicle, you can drive it. This thing, no physical form. It's just a right. What happens if the item has both a tangible and an intangible aspect towards it? What do you do? Is it going to be PPE or is it going to be IS 38 intangible? Will you identify which aspect is more significant, the tangible or the intangible? If the tangible is the significant part, then obviously PPE, IS 16. If the intangible is more significant, then obviously IS 38 intangible assets. So let's look at an example. Example of fishing license. A fishing license, right? We can talk about two types of fishing license. One is your recreational use, where you go to the post office and they'll give you a license. You can go and take your fishing rod now and go and fish. Right? The park somebody's not going to hassle you. Right? They're not going to steal your fish. They'll say, here's your license, you've got your license, that's fine, you can now fish. The other one is maybe a commercial fishing license. They tell you that you are now allowed to take your trawler and go and troll a net and catch a lot of fish and sell it to seafood stores. Right? So that's a fishing license. Now, a fishing license has a physical form. What is that? It's a piece of paper that you get, indicating that a particular person or company holds a license. Right? So that's your physical form, it's a piece of paper. It also has an intangible form, giving the person or the company the right to be allowed to fish based on the rules contained in the license. Okay, which one is more important, this paper or the actual right to go and fish? Well, ask yourself the question. You as a company, you're a fishing company. What do you want more? Do you want the right to go and fish? Or do you want the paper? Obviously, you want the right. If they told you, look, we're not going to give you a paper, but you are going to have the right to fish. You're obviously going to choose the right to fish. So just the paper being physical, that you can hold the paper, that's insignificant. The right, the intangible part of it is more significant. In such a case, the intangible aspect is more significant, as what is of importance is the ability and right to be able to fish rather than the physical proof that a fishing license is present. Obviously, that's important. You're not going to go and throw your document away. You're going to file it, make copies of it, you're going to make electronic copies of it. but in this case, intangible asset. You're not going to say PPE, fishing license. Another example, developing a prototype. What is a prototype? You went and did some research and you found out that you're going to be able to develop a new type of technology, a type of machine or some sort of model, and that can be used to produce or manufacture in bulk later on. Right? So prototype is an early sample or a model used to test a concept or a process or act as a thing to be replicated or learned from. Right? So the prototype does have a tangible aspect. It has it's a physical item that is used to test. It also has an intangible form. The prototype is formed as a result of months or even years of research and development and is therefore a byproduct of this knowledge rather than the physical parts that make the prototype up. Right? So for example, let's say you developed a new kind of router that you can take anywhere in South Africa. You can even be in the most remote location and it will have connection to the internet. It's super strong. Right? Now, that modem is made up out of plastic and a bit of metal. That plastic and metal cost about 1,000 rand. Now, are you going to say, okay, I've got this 1,000 rand PPE? Or are you going to say that this technology, this prototype that I've got in my hand, is actually the technology, this is the intangible form. The prototype, right, will be able to, and nobody else has this technology, I've developed it myself. Right? And someone is out there is going to be willing to purchase this from me for millions of rands. Right? Not because it's the 1,000 rand plastic, it's because of the technology behind it. Right? Because of the research behind it, of what it can do. He can go and produce this technology that nobody else has and sell it throughout the country. Right? So for a prototype, the intangible asset is also more significant, as the prototype would not exist without the prior research and development. Okay, so you've got to look at which is more significant. If the tangible is more, then it's IAS 16. If the intangible is more significant, IAS 38. And you're allowed to argue. You are an accounting student. You are looking at the theory. You're allowed to have your own opinion, but you must have some sort of discussion or some backing behind what you're claiming. If you can prove that to the auditors that you believe the intangible is more significant or the tangible is more significant, you can prove it to them and have a discussion with them. You can recognize it however you like. Okay, so that is the three parts of the definition, or the four parts of the definition. An intangible asset, identifiable, non-monetary asset without physical substance. Now that you've proved that it's an intangible asset, can you recognize it in your financial statements? That's where the recognition criteria comes in. What is the recognition criteria for intangible assets? The expected inflow of future economic benefits must be probable. So you've got to basically that this through purchasing this brand, for example, let's say you purchase the McDonald's brand, the expected inflow of future economic benefit has to be probable. So you're going to use that brand to sell quarter pounders and Royal Deluxes and whatever other burgers you get and French fries and those kind of things. So if you're going to do that, then obviously the inflow of future economic benefits is probable. If you buy this brand and you're just a rich man and you buy the brand and you're not going to use it, just buy the McDonald's brand and you throw it away in the bin, you don't use it, then you can't recognize it as an asset because you're not going to use it. It's not going to be probable. The cost is reliably measured. Now, if you bought this brand or paid for it, obviously it's reliably measured because you've got an invoice that says that you purchased this brand. Right, we've gone on for 40 minutes. Right? We've discussed the definition of an intangible asset and also the recognition criteria. Now, once you have proved, right, so let's say you get a question and the question is they give you a certain transaction or a few costs that you've incurred, you've bought a brand or something like that, and they tell you, how should this be recognized? So you go and write down your theory. You say that it can only be recognized as an intangible asset if it meets the definition. What's the definition? Identifiable non-monetary asset without physical substance. And it's also going to meet, so you go and prove each one of these items. Right? Then you go and prove the recognition criteria. If you are able to do that, then you can conclude at the end and say, therefore, this brand or whatever, this item, this patent, this copyright, this newspaper mast, whatever. There are some other examples. What are other examples of intangible assets? Brand names, author rights, computer software, license, franchises, copyrights, patents, recipes, formula, model designs, prototypes. Then you can say, therefore, this item meets the definition, this patent or this model meets the definition of it and recognition criteria of an intangible asset and can be recognized as an intangible asset. So your debit, intangible asset cost, and credit bank. Right, so that's initial theory. We are done with part one. When you debit intangible assets, at what amount are you going to debit it? Right, remember property, plant, and equipment, we debited it with costs. And what was the cost? It was purchase price plus everything else that is directly attributable. It's the same case here. Right, so remember, we are going down to the second part of the standard, which is initial measurement. When you first purchase this, you get this intangible asset and it's going to be recognized. It's initially measured at cost. What is cost? Purchase price plus directly attributable cost. For example, let's say you bought the McDonald's brand, but you needed to pay lawyers' fees to get this brand of 100,000. You'll add that to the cost. So you'll debit intangible asset not only a million rand or whatever purchase price, but you add the 100,000 as well. Don't forget to deduct discounts, rebates, refundable taxes like VAT, right? And add things like non-refundable taxes like import duties, customs, and that kind of thing. If you don't pay the import duty, you'll never be able to get that asset. So it's a directly attributable cost. Okay, what are directly attributable costs? The cost necessary to bring the asset to the condition that enables it to be used as intended by management. Right. And also don't forget about when the asset is paid for beyond normal credit terms. Right. The asset is measured at the present value of all future payments, and the difference between the payment made and the present value must be recognized as a finance cost. So we did an example of this during PPE where we said that, let's say, for example, you buy an asset, or let's talk about in terms of an intangible. Let's say you buy an intangible asset, and you're going to pay 1 million rand in a year's time. And in the question, they tell you about a market-related interest rate, or they give you an interest rate. what you're going to do is you need to present value that intangible asset to day one, and you debit it with a reduced amount. You won't debit it with £1 million in a year's time. You present value that amount and recognize it at the lower value, or the amount that is the present value. The future value is £1 million, which you're going to pay in a year's time. You present value, and anything, and the difference between the present value and the future value will be recognized as interest or a finance cost. Okay, we are going to come to an example of that in example 2. Right, so I'll show you the calculation of how to do that. Okay, it's 11:15. We are going to take a break here. During your break, if you feel you still have energy to read, you can read over example 1, which is going to be discuss initial recognition and initial measurement. Okay, 10 minutes or 9 minutes break. We're going to come back at 11:25. All right, guys, 11:25. Let's start off again. Got a few questions here in the chat. So after the break, can you please explain what capable of being separated from equity means? Well, as I said, it doesn't have to mean separated from the entity, equity. It can be separated from the entity. Right. So I think that is causing a bit of confusion, but I won't just leave it there. Even so, don't say equity. Let's change this. It's called the entity. Entity. Yeah. Thank you for picking that up. I need to. Okay, I'm going to replace the notes on learn so that this change is taken into account. Right. Now, capable of separated. What does that mean? So, for example, let's say you are a business and you have an excellent customer base. Why? Because you've done your business diligently. You've developed a good reputation. Let's say the name of your business is Majestic Travel and Tours. Right. So you always, when clients come to you, you welcome them. You always find the best travel option for them. You always have the best prices. When they go on the travel, you follow up with them. You make sure that that they're all okay in their hotel suites, that they have all activities, and if there's any issues, you always sort the issues out, and you make sure they come back happily and safely. Right? And you're known for that. So you recognize goodwill. Right? So you've got 500,000 rand worth of goodwill. Now, so you've got that on your financial statements. Can you take that 500,000 and sell it to Royal Travels and say, here's my goodwill, I'm giving it to you? You can't do that. You can't just sell your goodwill, because that's your goodwill associated with your Majestic brand. So you can't separate that goodwill and just give it to someone else. So that's internally generated goodwill. So you can never recognize internally generated goodwill as what you call it. You can never recognize internally generated goodwill as an intangible asset. Right. So that's what it means, capable of being separated. Now, another example would be if you were given a fishing license, right, and that fishing license was specially made just for your company. It's got your company name there. Now, and it is illegal for you to transfer this intangible asset to someone else. You can't, like, for example, I've got a fishing license, it's under my name. I can't go and give Joe Smith this fishing license and sell it to him for whatever, $70, and now he can take my fishing license and go and fish. So it can't be separated from me. That license is under my name. And the Department of Fishery doesn't allow me to go and sell this to someone else. So it can't be separated from me. But it doesn't mean that it's not going to be an intangible asset, because it can arise from contractual rights or legal rights. Now, that was the second question the student asked. They said, and also contractual rights. I was a little bit lost there. So what are contractual rights? You signed up with McDonald's and they told you, right, whatever your name is, Mr. Joe Smith, you are allowed to use the McDonald's brand and, for example, print it on your t-shirts, or make a restaurant with McDonald's brand name and sell McDonald's burgers. That's a contractual right, because you drew up a contract and that contract allowed you a trademark. That's the explanation of a contractual right. Okay, so let's pick up where we stopped. We stopped when we were talking about initial measurement, purchase price, and directly attributable costs. Right, so let's have a look at this example. A record company acquires the copyright of a musician, which allows the company to record the artist for a period of 5 years. During the first 6 months of the contract, the musician was very ill and could not record anything. The following costs were incurred regarding the copyright. Remember, we're talking about day one initial measurement. Right. Legal fees of 200,000 rand to help with the acquisition of the copyrights. Right. And 1,710,000 to purchase the copyright. So this is your purchase price, includes that. So obviously these two amounts are your purchase price and directly attributable costs. Because if you didn't pay this legal fees, you wouldn't be able to get yours. So it was to help with the acquisition of the copyright. So these two amounts, right, the 1.7, you're going to take out the VAT, right, your purchase price, times by 100 divided by 1.5. Right, that's 1,486,956.